So kia ora from Aotearoa, which in English means greetings and best wishes from New Zealand. As most of you know, I am Dr. Chris D'Souza. I am the CFO and CEO International, normally based in Melbourne, but for a few months I have been enjoying the awesome beauty and splendor working in Aotearoa, the land of the long white cloud. And to all our CMA friends from 104 countries around the globe, I extend a warm Kiwi welcome by saying "Nau mai harimai." It just means welcome in Maori. I'm joined today by a couple of really great people, a few great people. The best management accounting educator in the world, Professor Janak Rattatunga, the CEO of CMA Australia, and Professor Brendan O'Connell, a well-known global president, both of whom need no introduction specifically to this audience of CMAs. However, on behalf of CMA NZ and CMA New Zealand, it is my privilege to warmly welcome and introduce our webinar presenter for this evening. I have the pleasure of personally meeting Professor Charles de Villiers, no relation of A.B. de Villiers, I'm told, who is a professor of accounting at the University of Auckland, New Zealand. Now, whenever I speak to knowledgeable people about this webinar, their common response has been, there's no one with better knowledge of this subject than Professor Charles. He's internationally renowned for his sustainability accounting and integrated reporting research and expertise. Professor Charles is also an adjunct professor in several South African and a Malaysian university. He has over 350 research-based publications and presentations, including more than 100 articles in refereed journals and 2 Routledge published edited books. He has published in many of the top accounting and management journals. As an indication of the impact his research has had, he has been cited more than 8,000 times in total, including more than 1,800 times during 2021 alone, for an overall H index of 48. Now, H index means he has 48 publications that have been cited at least 48 times. Professor Charles has published several articles and continues to do research on the changing sustainability reporting standards, setting and the reporting standard setting landscape, which is the topic of today's presentation. Now, before I hand you over to Professor Charles, I want to request you all to put your questions in the Q&A box and not in the chat. The chat has been disabled, so please put all your questions in the Q&A. Over to you, Prof. Charles de Villiers.
Thank you very much for that fantastic introduction. It's absolutely fantastic to hear that sort of introduction. I just want to get my screens right here so that I have the correct screen in front of me so that I don't have to look over to the side. There we go. Yes, so I do research in this area of sustainability reporting, and obviously I get very excited about all this sort of thing, and all the activity that's happening in this space at the moment is quite exciting for people like me. I realize that for some other people, of course, they're not that interested in it, and so I'm happy to share some of what I've picked up over time of where we are in this very dynamic period of standard setting at the moment. I mean, sustainability reporting has been around for a very, very long time, and I think the term sustainability reporting is a bit misleading and nobody really knows what it means, but I think it's a bit simpler if we just go, it's about social and environmental things that organizations report to people outside of the organization. And in that way, we can all understand what it's all about. But, the IFRS, who is setting our financial reporting standards, have now gotten involved in setting standards for sustainability reporting, and even the SEC in America. Now, the SEC is only there to protect investors, And they are pretty hard-nosed people who never in the past, I would have thought, would have been interested in social and environmental issues, but they are getting involved as well. And then EFRAG is a European organization, and we'll talk about some of the developments in a moment. But in the introduction to, or in the invitation to today's session, some of these questions were in there, and we are going to try and answer some of them. What is likely to happen in this area? How does the IFRS fit into all of this? What are all these different standard setters, and how can we really accommodate all of them in what we are doing in our organizations? And how do management accountants fit into all of this? So the IFRS, of course, looks after financial reporting standards, but they are now getting involved, and they, along with many other standard setting bodies, have started with climate change. Climate change seems to be something that is exercising a lot of people, because I think of the risk element, that people have woken up to the fact that climate change involves risk for organizations, and that investors are obviously interested in risk and returns. And so if there's something that constitutes risk, then it needs to be disclosed to investors so that they can make informed decisions. So a lot of this is driven by this risk element, and also by the interest in climate change, but it does go a little bit broader than that. So the IFRS have now formed the IASB for the sustainability reporting standards. But this word sustainability means different things to different people, even though everybody will probably agree that it has something to do with social issues and with environmental issues. Still, people use it in different ways. So it is worth just spending a minute on sorting out how it fits together, what people understand. And I'm hoping that in this discussion, it'll also become clear why some people talk past each other when they talk about sustainability. It's because they mean completely different things. And they may think they mean the same thing just because they're using the same term. But on this continuum I have here, I've got the economic focus. You'll see on those arrows at the bottom. I've got the economic focus at the bottom on the left-hand side, and I've got the broader societal focus on the right-hand side. And then if we go back to the top, to those boxes at the top, you'll see on the left that I'm talking about information on the impact of the environment on the firm. So you can see that that's the kind of information that investors would be interested in. It's about creating firm value. It's about sustainability of the firm. It's about risk and return for investors. Whereas on the right-hand side, if you take a broader societal focus, then it's really about impact of the firm on the environment or on society. So if you take that perspective, you'd be interested in societal value, creating societal value, not just firm value, not just for investors, but also for other people in society. I mean, think about it. Employees get impacted by firm behavior. Their customers get impacted by firm behavior, and broader society as well. I don't have to go through all the list of stakeholders. But we're talking about sustainability of society. We're talking about sustainability of the natural environment. And we're talking about, well, if we have to take an investor view, risk and reward for society. But, you know, the two are not the same. And that's why there's that equal and crossed out in the middle, and there's that little box in the middle that says the problem of the commons. And a lot of people refer to that as the tragedy of the commons. But the problem of the commons is an age-old ethical dilemma where something belongs to a group, and in this case, the natural environment belongs to a group. And for the group, it's important that that asset, that natural environment is maintained in a good state. But for each individual in the group, they don't really have that incentive. And so for each individual firm, you could say, or for each investor, they just want to make more money. And it doesn't really matter to them that much what happens to the environment, the natural environment that they rely on in order to create firm value. So that's, I mean, the problem of the commons, and actually it's turning into the tragedy of the commons. And this is basically why people talk about sustainability, and they mean different things, and they can never basically agree. They sort of talk past each other because of this reason. So who wants non-financial information or sustainability information? And I've placed them on the same continuum that you see at the bottom here: economic focus on the one side and broader societal focus on the other. And of course, investors and regulators and capital markets in general, they are interested in the economic focus. And then on the right-hand side here, communities, employees, customers, future generations, the environment. You know, think about the trees and the frogs. They don't have somebody to talk for them. But anyway, I'll stop there and move on to how can we make sense, you know, of all these sustainability reporting standard setters and standard producers, I call them here. How can we make sense of them? Because there are so many these days. And I've used the same continuum again, starting from the economic focus on the left and going towards the broader societal focus on the right. And I've placed a lot of these names on here. And you'll see over here the IFRS, who is now getting involved through their establishment of the IASB. In their activities, they've actually, you could say, mopped up some of these previous standard setters and gotten them involved under the same umbrella, under the IASB umbrella. And that is Integrated Reporting and the Sustainability Accounting Standards Board. These two have come together to form the Value Reporting Foundation at the top here. And the Value Reporting Foundation has thrown its lot in with the IASB. And then the TCFD, and they're more interested in climate-related financial disclosures. The TCFD is also involved in the IASB. So they're all together, you could say. And you could say you could throw a blanket over them. They're all together now. And it could be that these others will disappear after they have started to integrate their ideas into the IASB. You could imagine that after a couple of years, it might not be necessary for them to have a separate identity anymore. But the things that I wanted to show here is the EFRAG, which is sort of seems to be interested in things that go a little bit more towards the broader societal focus. They are based in Europe, and this is they are currently working on new regulation that will impact all European firms and a broader set of organizations as well in the European Union. And then over here we have the GRI, the Global Reporting Initiative, and their standards are more towards this idea of providing information about how the firm or the reporting organization is going to influence society and the environment, and is already influencing those matters. I've got the SDGs, the United Nations Sustainable Development Goals over here. They are not necessarily, they're not really reporting standards, but you could see them as a summary of the major issues that face humanity. You know, as accountants, we can get very excited about reporting and governance and high level things like that. But after all, the things that really count in society is, you know, that we shouldn't really have kids that live in poverty. We shouldn't really have people who go without food. We really want everybody to have meaningful work and that sort of thing. So the SDGs really is, you could say, a reminder of what is important to us in broader society. So yes, just looking at this picture over here, you can see that the IFRS and the IASB, the newly formed IASB, is playing and is going to play a major role in this sustainability report setting environment, because, as you know, that IFRS provide the reporting standards, and of course they cannot enforce it all over the world, but each jurisdiction decides how they deal with a new standard that comes through from the IFRS. And in most jurisdictions, it has to be approved on a standard by standard basis. But there are a few countries, like South Africa, for instance, who has just said that, not just now, but I mean long ago, that each IFRS standard will apply fully the minute that it comes out. So it's interesting, because once these sustainability reporting standards come out, then they will also have to be followed by a broad cross-section of firms, depending on the different countries. But I'm expecting that they are going to be approved in many, many, many countries. So we've used IFRS, we've used IASB, and we've used ISSB. What does it mean? How does it all fit together? So most of you probably know all this stuff, but anyway, just to summarize it again, the IFRS, they've got their monitoring board and their foundation trustees. Then on the left-hand side there, you can see they've got the IASB, the International Accounting Standards Board, and they're responsible for setting the financial accounting standards, or the reporting standards of financial matters. These are the IFRS standards that we know. And then on the right-hand side, you see the newly formed ISSB. They are still very new, but they already have 2 exposure drafts out there, and they are moving these things through the steps in record time. In the old days, a financial reporting standard would take many, many, many months, years to go through all the steps. They are moving these sustainability standards very, very quickly, because they are building on some of the pre-existing knowledge from these other standard setters that they have now incorporated in what they are doing. So you can see that they are planning to come up with sustainability disclosure standards. And you'll see that it's focused on the information needs of investors. But anyway, I'll talk about that in a minute. But they already have 2 exposure drafts out. And these are the general requirements exposure draft and the climate exposure draft. So the one on the left is the general requirements for for the disclosure of sustainability-related financial information. So again, it's sustainability, but it's financial information. And it is sustainability, but it's sustainability for investors. So that means it's social and environmental issues for the benefit of investors to determine risk and reward. So in other words, it's about how society and the natural environment will influence the firm and the firm's ability to create value. The same, of course, goes with the climate exposure draft. But so the general one is going to say, I have a slide on it. Let me just go to the next one. The general requirements one is going to say, the focus is on significant sustainability-related risks and opportunities. So it's sustainability-related, in other words, social and environmental things, but it's about risk and reward. And if you look on the right-hand side, where under the money bag here, then it says that could reasonably be expected to influence decisions that investors would make. In other words, it's the materiality requirement is that as an investor, you would change your mind about it. Of course, if something impacts that the firm is doing impacts society, and that impact is unacceptable to society, then society will make rules and will make the firm pay. And that constitutes a risk, right? So if it's big enough for society to notice and change the rules, then I guess you would have to tell your investors about it. So by that argument, the IFRS people and the IASB people believe that everything that is important for society is also important for an investor. But as I'll explain in a minute, that's not quite true. But anyway, there is I mean, you can see the logic in what they are saying. So I just have this slide as well, and this is from IFRS sources at the top there that says, must disclose material information about all the significant sustainability-related risks and opportunities to which the entity is exposed. And materiality is assessed on the basis of what an investor thinks and in terms of enterprise value. So it's social and environmental issues that could potentially constitute risk or opportunities. And that information needs to be disclosed. Well, I guess it fits into the general framework of IFRS standards that you could argue that firms already have to disclose these things. It's just said now explicitly that you also have to think about risk and reward out of social and environmental issues or sustainability related issues. And this is again what the IFRS says. They've got on the left-hand side here, the IASB, the financial standards or the accounting standards. And then they've got the sustainability standards. This is now what will be in future. And then at the top, they've got the standards of the two kinds. And then there is the disclosure. There is the financial statement that will have to provide these disclosures. And you can see it, the picture shows it's like a little puzzle that's fitted together. So in other words, there needs to be connectivity between the financial information and the social and environmental information. So it shouldn't just be tell us, give us the financial report, and then give us another few pages on social issues and give us another few pages on environmental issues. No, you should be marrying it up and say how the social and financial and environmental issues impact the financial issues. And it's all about, on the right-hand side here, investors and capital market participants, their information needs. So this is now from the Value Reporting Foundation, and remember they were the Sustainability Accounting Standards Board, the IASB, the Americans, and the Integrated Reporting Foundation. Those guys got together to form the Value Reporting Foundation. And according to them, and also according to statements that have been made recently by the IASB or the IFRS Foundation, and I'll get to that, this is how all these things and standards fit together. So they go, well, there's in the bottom left-hand side here, there's the financial reporting standards that we know and some of us love. And then on top of that, there's going to be the sustainability reporting standards from the IASB. So that's the social and environmental issues that need to be disclosed. But that's kind of, it could be done like an integrated report. Like the integrated reporting people always said, these things need to be put together in a way that makes sense, not just in separate parts. So that could be an integrated report, the dark blue part, and then the light blue part over here is about the broader multi-stakeholder focus, or the sort of the GRI focus. So the GRI standards, that suggests that companies could and maybe should be providing more information that is the kind of information about how the firm impacts society and the natural environment, rather than in the dark blue part here, how society and the environment might impact the firm's ability to create value. So, so yes, the IFRS standards, the IFRS people say that everything that's material needs to be disclosed, and therefore that should be good enough for all stakeholders. But of course, there is a slight misunderstanding there because of that problem of the commons issue that says that these two things are not really the same. You know, there's the this idea at the bottom here that firms always want to grow. Now, you could be the most efficient firm in the world, but if you keep growing, then you are going to use more and more resources, and this could be problematic. And then also another major problem is this one of your ability to cleanse the balance sheet of dirty assets. You could get one of your senior managers to buy part of your operations, the unclean part of your operations, and then you buy from them, and it's off balance sheet, and yes, but everything is really still the same. So from a broader societal point of view, nothing has really changed, but the firm looks a bit better now. So just on that idea of integrated reporting, this was recently said on the 25th of May. There was a joint statement by the chair of the IASB and the chair of the ISSB. So the two arms, you could say, that the one makes the accounting standards or financial reporting standards, the other one makes the sustainability standards. And they said they are convinced that integrated reporting drives high quality corporate reports, and that they strongly encourage the continued use of integrated reporting and integrated thinking. So we haven't really talked about what integrated thinking is, and we haven't talked too much about what integrated reporting is, but it does appear that under the new umbrella, that integrated reporting may still have a place, and in fact may be promoted now by a much larger, more influential organization, with much broader global reach than was the case before. That could be the case, or of course, the alternative is that, well, they may pay lip service to this, and this idea of integrated reporting and integrated thinking may fade away a little bit in future and be seen as less important. Nevertheless, it does seem that the principles underlying integrated reporting is going to be supported by the IFRS. This idea that financial and non-financial information needs to be provided in a way that is integrated, that is somehow linked and connected, not in separate silos or separate bits of information. So I just have this slide here that talks about the shortcomings of financial reporting. Of course, we all know that financial reporting basically gives you a view of the past, and it doesn't really give you what the investors really want is, what is the strategy? What is the business plan? What's the business model? How are you going to create value? And how is that going to happen next year? Not last year's plan, last year's history, but next year's plans. And what other stakeholders want to know is, how will your decisions and operations influence the natural environment and society? So you could argue that a traditional financial report doesn't give you any of that information. And of course, that's where integrated reporting comes in, that it's supposed to be financial and non-financial information that's integrated. It's supposed to be based on this process of integrated thinking, where managers are really considering all these impacts together in their decision making. And it's supposed to tell the organization's future value creation story. How will we make money in future? It's supposed to be linked to the business model and the strategy. And it's supposed to talk about the different capitals, including human, social, relationship, and natural capital. So you can see that those words I've been summarizing as social and environmental. So integrated reporting is basically value reporting, and it's some you also use integrated reporting for sustainability. In other words, social and environmental issues. In other words, how the firm impacts society and the environment. So there's research evidence that show that some firms don't really just use integrated reporting as a mechanism for value reporting, but uses it as a mechanism for stakeholder engagement, talking to people, including employees and customers and broader society, and explaining to them what is going on in the firm and what they are interested in doing in the firm. Oh, here's a shameless plug for the Routledge Handbook of Integrated Reporting. If you need more information about integrated reporting, there's 30 chapters by more than 60 authors. It was published in 2020, and the first chapter of that book is available on the internet, freely available. You can look it up, and it kind of summarizes what's going on in the book. But the book provides different views, practitioner views, and as well as critical views, as well as research evidence. It really is quite a good starting place if you are interested in this concept of integrated reporting. There's even a couple of chapters on integrated thinking as well. That's just a citation of that book. On integrated thinking, there's this book chapter that provides empirical evidence that organizations that use integrated thinking were able to deal with a crisis much better because they were focusing on the important long-term strategic issues. And so integrated thinking is perhaps also a way to, a different way of thinking about how to manage an organization, how to do strategic planning for an organization. So yes, it's something to think about, integrated thinking. And as management accountants, as managers, as people who are running organizations and who are managing organizations, you'd be interested in integrated thinking. Also, just getting more into this idea of what are the links between management accounting and sustainability reporting. And I want to say management accounting includes things like management control systems, things like the balanced scorecard, things like providing the information and the analysis that is needed for managers to make informed decisions and to manage the organization, and also performance management systems, which is all about the measurement of components of the business, of managers' individual performance, etc. Now, of course, external reporting relies on these internal systems, and that includes things like sustainability reporting. You can't really have a sustainability report or information that goes into that external reporting that just comes out of the blue. It's not, you can't just ask the marketing department to write a couple of nice pages. It doesn't work that way. It needs to be just like financial information. There needs to be a system that underlies the capturing of the information and the management of these elements that you are going to disclose. I mean, if something is a risk, that emanates from social or environmental matters, then that risk needs to be managed. And there would have to be measurement and management reporting, internal reporting to manage it. So initiatives, the other thing that we know, of course, about any initiative in an organization, let's say something like sustainability reporting, is that they do not thrive without management support and with management systems support, without the reporting. Once you have the reporting, the measurement and the reporting, then managers are able to deal with it and actively manage these things. So here's an example just of a model that shows the links between these different elements: the internal management control aspects or management accounting aspects, and the external reporting. So in this paper, we have this model where if you look at the three elements in the middle, the three boxes in the middle that is shaded in light blue, you'll see this sustainability report there, the external report, and you'll also see the balanced scorecard that is an internal mechanism, of course, that management use. And then the third box there is the focus of management discussion. So they use these other elements, and that kind of focuses their view. So, I mean, you know that the balanced scorecard does that. The measurements on the balanced scorecard are the things that managers are going to pay attention to. And then you'll see around that, on the outer circle, there are two other, the two white boxes. And one of them in this firm is the key accountabilities report for each individual. There is a key accountabilities report, and there is a discussion with a manager. And then at the bottom there, all of this is informed by what stakeholders think and the feedback that comes from stakeholders. It's interesting that the the integrated reporting framework suggests that disclosures should be on the basis of a stakeholder engagement process and asking and talking to stakeholders about their information needs. What is it that they see as important? And the same goes for the GRI. The Global Reporting Initiative says that this should be the thing that underlies external reporting of social and environmental matters, this stakeholder engagement process, which helps you to identify material issues that needs to be reported. So stakeholder engagement is quite an important thing. That's different from financial reporting, where we make up, we decide ourselves what materiality is. Materiality is a much simpler concept when it comes to financial matters. And then, of course, we have external auditors to come and also provide some input on that. That's an interesting element to see how that develops, that in some jurisdictions, in some areas, there are the external auditors. The auditors are going to have to get involved and provide assurance over these sustainability type information that gets disclosed. I'm not going to go into that at the moment. I'm just want to talk about management accountants. So basically, to summarize, management accountants have a key role to play in developing the data and the motivational systems to effectively implement sustainability reporting. I don't think sustainability reporting can be seen as just a little cherry on top, just a little marketing exercise. It needs to be, there needs to be this framework underneath, the support of information and systems. And reporting leads to renewed interest in managing these underlying issues. And of course, then management accountants will play a role in that as well. Okay, so we're getting towards the end of the presentation now. I just wanted to say that it's kind of clear that sustainability and non-financial reporting has really gone mainstream now. There are more and more, of course, stakeholders have always been interested, but there are more and more others now also interested, the likes of the IFRS and the SEC in America, and EFRAG, and the XRB is the New Zealand External Reporting Board, and they are also developing reporting standards, climate related. They're starting with climate related standards, both the same as the SEC. So there's more regulation just developing all over the world. And it's not just in these countries that I've mentioned. Of course, there are initiatives just about everywhere, in Indonesia, Malaysia. So it's not just in these developed countries, it's really all over. I've got this paper here. I don't want to talk too much about it, but it's a paper that shows that shareholders, investors, are willing to pay for additional financial and environmental disclosures. This is amazing. This is actual evidence that shareholders are willing to forfeit investment returns if they get more information. So this is, I mean, if you're a practitioner, if you're in a company, if you're a director, then what more information do you need to motivate you to provide environmental disclosure? I'm not going to go into the detail on what we did and how we did it and all the benefits and the mechanisms. You can probably work it out for yourself, the mechanisms whereby investors are prepared to pay less. It's basically you're providing more information to them so they are able to more fully assess risk and reward. And if they don't have that information and they have any doubts over something, then the only way to protect themselves is to assume the worst case scenario. So disclosure is a good thing, generally speaking, because you allow investors to make that better informed assessment, which means that they can up their assessment because they don't have to assume the worst case scenario. They know more, so they can be more precise in what they decide. Here's another paper that shows that it provides evidence that companies use regular mechanisms within companies are used to influence environmental performance. And this is about risk committees. This is a board committee that is responsible for risk management. And it's not risk management of environmental issues, it's risk management, period. But we find that companies that have certain characteristics and these risk board committees, they have better environmental performance. And in fact, after they come into being, environmental performance improves. So that's interesting to see as well, that these things have really gone mainstream now. It's not just something that some true believer says, oh yes, social environmental things are so wonderful. No, every hard-nosed businessman today takes these things seriously. So overall, getting back to the sustainability disclosure standards, what can we say? What is the purpose of the sustainability disclosure standards? Basically, the short answer, it's about value for the business. It's about how society and the environment could impact the firm. So it's about investor information needs. Most of them are like that. The GRI standards are an exception to that rule, really, that they are more about the how the firm impacts society and the natural environment. So some sustainability reporting is about that angle of it. But anyway, overall now there is an understanding that sustainability matters are important, that we should be paying attention to it. And I think most company boards have taken that on board within the last couple of years, if not before that, of course. Okay, so thank you for the opportunity to present, and I'm happy to answer any questions, or if there are comments or suggestions or anything like that, please feel free to let us know. I'm going to...
Thanks, Professor Shal. That was fantastic. I'll ask Professor Janak to ask the questions, because there are a few questions, and I think he'll be able to ask the questions and summarize them for us. Yep.
I'm not sure if you can see the questions, but I can read some of the questions out, perhaps not in the order asked, but in the order of the relevance to what you were talking about. The first question is from Kennedy. He says, several authors have used sustainability and ESG interchangeably. Do you agree with this? I also observe that you haven't mentioned anything on the governance component of sustainability. Is it out of the sustainability model?
Can you just repeat that again? Sustainability and which other concept?
ESG. ESG, yeah.
Okay. Yes. I mean, sustainability is kind of a meaningless word to me, because it means so many different things to different people. So I kind of like ESG a little bit better in the sense that it's more explanatory. It says environment, society, and governance, and that makes sense to me. I mean, ES is one thing to me, and G is a little bit of a different thing to me. I don't really see them as at the same level. because governance, yes, governance is important, and we want firms to look after ES matters. But of course, governance is also relates to other things other than social and environmental issues. So governance, I mean, to me, is about the board of directors, but not just about the board of directors, also about other mechanisms. I've done some research on board characteristics and how that impacts on environmental performance and CSR performance. And it's quite fascinating to see how certain characteristics of boards actually match quite strongly with CSR performance. I don't know if I've answered the question fully, but I'm happy to elaborate if.
Charles, actually, you have answered the question. In fact, in our CMA program, we definitely separate out the environmental and social in a separate section to the governance. We don't see that connection between governance and ES and ES. So yes, we also take it separate because the governance issues are far greater than the environmental and vice versa. Yes. So thank you for that. The next question.
Yes, the other, if I could just say quickly, the other reason why I see G, the governance part, as slightly different is when you use data from an ESG database, as I and my co-authors often do, then to link that ESG score to something else, or to see how that influences something else, or how something else influences that, then we most of the time we separate out the ES part of it and the G part of it, because because it's just separate things in my mind in terms of a conceptual thing.
Another question that is interesting is by Mr. Kartiga. He says, how can we draft the reporting system via online draft for statistical information on financial reporting standards? Is it any specific tools and materials for that? So I think they're talking about some sort of online reporting system, is what I'm gathering from this question.
Yes, there's that system that they are trying to promote, where users can get information straight from the raw data, and then put the information together for themselves. And I think there's probably room for that sort of thing to happen with social and environmental information as well. I'm not an expert on that sort of thing, so I can't comment too much.
Brendan, do you have any questions for Charles? You got your camera off and your mic is on mute, but if you have any questions, there are some others that are.
Sorry, Janik, yes. Yeah.
Okay.
Janik, yeah, I'm here, sorry. Yeah, look, I guess for me, in looking at this area, there's such a disparity of approaches to reporting, and I've looked at a lot of sustainability reports over the years, and no two ever look alike. And so it becomes very, I think, difficult for the user. And I also think a lot of organisations only want to disclose good news, not bad news. And so they often just read like a public relations document rather than an objective report. So I'd be interested to get your perspective on that, Charles.
Yes, that's certainly the case. I mean, it goes without saying that organizations try to make everything sound good. If they have good news to report, of course, they make it sound even better. And if they have bad news, then they add explanation to it, and they explain why it shouldn't be seen as quite as bad as you might have thought. And they explain what they are doing to manage the situation and all that sort of thing. Now, a lot of people go freak out. You know, they go, "Oh, this is horrible. They do all of this." But I mean, these are professional managers. What would you expect them to do? Of course, this is what they have to do. This is their job. They have to explain. So, I mean, I understand the argument from both ends, that on the one hand, yes, it's horrible what they can get away with, because these are powerful people. They're in a position of power. They can just make things sound better than it actually is. But on the other hand, of course, they must explain what they are doing, and hopefully they are doing it, and they are under enough pressure so that they actually do it. And I mean, there's evidence where people, there's an environmental crisis that involves the firm, and the CEO gets forced to step down, and then the next CEO hopefully implements systems and management procedures that improve things. But yes, it is true that these companies are very powerful, and they can do horrible things. And one of the really bad things, somebody explained this to me long ago, and I sort of didn't pay attention at the time, but I'm coming to understand what he meant, is that these multinationals are the worst, because, you know, if you live in Melbourne and you're the CEO of a company that operates in Melbourne, and your employees are in Melbourne, and your customers are in Melbourne, then you look after Melbourne. But if you are, you know, the head of a multinational that's worth $1 trillion, and you have operations all over the world, then Melbourne is a very small little thing and not very important necessarily to you. And you end up making trade-offs where you could be firing the 10,000 people who work in Melbourne at the stroke of a pen, and you don't really care because you don't live in Melbourne. So you know, I don't know, multinationals are, it's a difficult animal to control, because you can understand, if you're the CEO, then that local operation in that far off place is not that important, and you have to make the most of the organization as a whole. But that's not good for society in that far off place.
I agree. Just on multinationals, I seem to recall that British Petroleum, BP, won a prestigious award for the quality of its sustainability reporting a few months before the oil disaster that happened in the Gulf of Mexico.
Yes.
So
Well, don't get me started on oil companies. I mean, how can you be sustainable if you're an oil company? Because you're taking stuff out of the ground and you're getting your customers to burn it up. You can't replace it. How can it be sustainable? But anyway, that's for another time.
Charles, I want to ask a question directly, which I'm a bit of a cynic with the IFRS. I have written papers as to why accounting statements are untrue and unfair. And the basic, cynicism starts from the fact that they can't get financial standards right, but they leave out the entire area of intangibles. And they have done this for years. And then most of our knowledge companies have intangibles. So if they can't get the value of intangibles right, how the hell are they going to get the value of all the sustainability and all of these? I mean, is this just an exercise for them to charge more money for auditing sustainability reports?
Yes. No, well, the IFRS, of course, are not the guys who are going to provide the assurance services. But of course, all the professional accounting firms love this stuff, because it's definitely going to provide additional opportunities for them to do business. But it's also going to be quite risky for them to do this business. But anyway, wherever there's risk, there's reward, right? They could charge more. Look, I'm not a big fan of the IFRS. In my whole presentation, I was trying to to convey the information about what's going on. And of course, we'll have to see what happens. The main thing to realize is that the IFRS, their sustainability reporting standards will be there for investors, not for broader society. And so, so we need to understand that. But at the same time, their standards are probably going to be applicable and followed by more organizations than would have been the case if they didn't get involved. So that's the good news part of it for me.
One other question from me, and I will return to the questions of the participants, and that is, you said that they must disclose, okay, in their financial statement. Now, how are they going to do it practically? Do they put a double entry that they say this is the sustainability, or is it as a note to the accounts? How are they going to disclose sustainability disclosures in the financial reports?
I think this is about disclosing information about risk and reward. So, for instance, if you think about the environment and you think about climate change, that's quite an easy thing to get your head around. That if it's about CO2 emissions, and if your firm is involved in CO2 emissions, then there's a risk that it's going to become more expensive for you to do that in future due to regulation. And so you would have to disclose that, and you would have to say what the impact of that might be. If you're an oil company and your whole business is you're basically going to be put out of business, then you're going to have to explain when you think this is going to happen, and what are you going to do about it? Are you going to diversify? I mean, it's not going to help you if you're an oil company to put up a few charging stations. That's not going to be enough. That's not going to be able to replace the billions of dollars you're making. So, I think that's the kind of thing that they will have to disclose.
No, my question really is, how do you bring to the account? I mean, is it a contingent liability? Is it notes? Or because IFRS does not allow you to keep contingent liabilities out of the balance sheet. So do you have to bring it into the balance sheet? It's a bit confusing to me, you know.
Yes, no, I mean that's a whole new area that you could argue that the current IFRS standards already require you to disclose things like that about risk. And it could be either that it enters the balance sheet on that basis, like a contingent liability, or that it is just information, like a footnote, that you provide additional information. But not just risk, you should also be providing information about opportunity. In other words, you should be saying that because we're in this business, or because of this changing ideas within society related to climate change, we are going to go in this direction and develop a whole suite of products or services that will take advantage of that sort of thing. So it's not just risk, it's also opportunity.
Thanks, Daniel. There's a question, sorry, Stansha, there's a question from Daniel in Ghana. She's saying, in the presentation, some standards can fully be applied in Africa and some other countries not. What is the connection? So is the application just subjective, is the question.
Well, I mean, if we are specifically talking about the IASB standards that are going to come out, the sustainability standards under the IFRS, then each country, of course, decide which standards they implement and endorse. So it could be that Ghana decides not to endorse it. I'm not exactly sure how it works in Ghana, whether, but I'm just working under the assumption that they decide on each standard that comes out from the IFRS, whether they implement it or not in their country, whether they endorse it. So that'll be the case for each African country. The one African country I can comment on is South Africa. Over there, the rule is that everything that comes from the IFRS is law. That's it. So
but at the same time, we have USA that says that we don't accept IFRS. We're going back to GAAP, you know.
Yes.
So
yes. But there is also some good news there. The good news there to me is that yes, the Americans think they know everything and nobody else knows anything, so they just go their own way. But they have joint task forces on new developments. So you get the IFRS people that go together with the GAAP people, and what's it called? The IAS. What
IASB.
it's called?
IASB.
The American lot. They talk about new developments together, so that they come up with things that are sort of similar and compatible. So who knows? Watch the space within the next few decades. Maybe we will get a bit closer towards that sort of agreement.
Okay. There's another question which is quite interesting. Who would be the deciding authority to approve the value inside sustainability reports of the company? So in other words, who will?
Well, I mean, the companies decide for themselves, right? And then auditors have to put a rubber stamp on it.
Right.
So yeah, I guess that'll be the same. It'll just be that for some of these things, it'll be quite hard to assess, of course. But the company will have to put together the information, and they will have to put forward their arguments to the auditors.
Brendan, you have any other questions for Charles or comments?
Yeah, thanks, Janik. Look, I think the developments are interesting. It's taken a long time for financial reporting standards to get the necessary level of agreements and integration globally. I would imagine that these moves towards international sustainability reporting standards will also take decades. So I think we're really still at the early stages of all of this. So I find it hard to see anytime soon where you're going to get some level of comparability or application globally. And don't forget the countries where their large greenhouse gas emitters are probably going to be the most stubborn when it comes to forcing this upon their companies. So yeah, I think there's a lot of challenges ahead. Would you agree with that, Charles?
Yes, certainly. I mean, the IFRS is quite a powerful organization, not because they have power to enforce anything, but because they have been endorsed by so many regulators in so many different countries. So whatever comes from them is going to carry a lot more weight than anything that came from all these other standard setters that went before them. So there is the possibility that a lot of things are going to change in a relatively short period of time. They are also pushing these standards through at breakneck speed compared to what they usually take for these financial standards that were promulgated in the past. So that's on the plus side. What you mentioned about countries that have that don't have rules, many rules about CO2 emissions and things like that. If that's the case, then if they don't have enforcement, then you could argue that these companies don't run a risk, and then they won't have much to report. So the reporting is one part, the enforcement of change is another part. So what we've been talking about has only been about disclosure. Of course, what happens, often happens, is after disclosure, then stakeholders, people out there, pressure groups, get to see the information, and then they start to latch onto it and demand more action. So it could be that something like that happens. And that's, of course, the reason why a lot of companies don't want to disclose. But it's going to become more and more difficult for large companies with many stakeholders, people with lots of customers, for instance, or lots of employees. It's going to become very difficult for them not to disclose social and environmental information simply because their customers and their employees will demand it.
I liked your view about cleansing the balance sheet of dirty assets. That's happening all the time in Australia. Very large coal mining companies are selling off that part of their assets to someone else. So the pollution continues, but under a different name. We have, at the moment, I'm doing some research onto mining companies that are given a permit to mine, as long as they can, when they finish mining, they can cover up the mine and put grass and make it all good. What they do is they come to a level where it's still very, very toxic, and then they sell that pit to someone else who basically is bankrupt or something, and that pit is never closed. So these are the things that are happening. A lot of gaming of the dirty assets. You're quite right. That's going to happen.
Yeah. Yes, we hope. We of course we live in hope that these things won't happen, because sustainability is a thing that influences all of us. So really, it's hard to assess sustainability for an individual organization.
We had a Australian company, the largest emitter called AGL, right? That was trying to break up the firm into these bits, and luckily a young billionaire came and got into the board and stopped it, because he wants to convert and get them off coal very quickly. Okay, so we've had some very interesting people as well in the other side of the equation.
Yes, I read about that.
Chintan, how are we doing for time? I can ask a few other questions.
Probably just one more.
Okay, well, the last one is, will the sustainability standards apply to public and private sectors? Is the question that Dara is asking.
I suspect that it's going to apply to the private sector only. I'm not 100% sure about what I'm saying now, but the IFRS is all about investor protection, right? So yes, that kind of implies companies that are listed on the stock exchange.
Chintan, there are lots of questions here, but I think we're running out of time. So,
yep. So before we close off, can I say that there's a lot more we can cover, and we are going to cover it from Janak and Professor Brendan, our president, Professor Brendan. Prof. Brendan, I hope I introduced in the beginning. If I did, sorry, Professor Brendan, who's the president of ICMA, and Professor Janak are both coming to New Zealand actually in August. So I'm giving a plug. I'm here in New Zealand, so I'm trying to give a plug for them that they'll be available in, they'll be visiting most of the cities in different universities, University of Wellington, University of Canterbury, University of Auckland here, and University of Otago, to give seminars. So if you are interested in meeting them, or if you're interested in doing the CMA program, which is a great program, one of the best in the world, please contact me. And I've given you my details, or you can contact CMA at info@cmaaustralia.edu.au. That's what I have to say. And Prof. Charles, any closing remarks?
Thank you very much for the opportunity to present. It was absolutely fantastic. I'm so happy that so many people came along to listen to the remarks. And look, I can talk about this stuff for a long time because I'm pretty enthusiastic about it. But of course, I try to stick to the time that was allocated. And no, it's wonderful. It's wonderful. If anybody wants to talk about these things, or for me to engage in some other way, I'm always very happy to do so. Thank you very much for the opportunity.
It's not just you, Prof. Charles. We are also very enthusiastic about it.
Yes. I mean, look at all those things on that banner. It's all the things we've been talking about today.
Yes. And it's the things that we cover in the CMA program. I have to say that. Prof.
Yes.
Janak and Prof. Brendan, before we close off.
Perfect.
So,
All right, we close it off.
Now, Prof. Janak, you want to say something? Prof. Brendan?
Thank you very much, Charles. I mean, you've given me a good insight onto that separation of economic and society's views and what the valuation is. That's something that I sort of knew, but I couldn't really put my finger into. You explained it very, very well. So thank you very much for that. I think we are going to have a very heated discussion on this when we meet in Auckland. Okay. So I look forward to our discussion.
Brilliant. Yes. Thank you very much.
It was a great.
And thank you, Charles.
Bye, everybody.
Thank you very much. And I can't resist saying Airera or goodbye from New Zealand. Okay. Bye, guys.
Bye-bye, everybody.
Bye-bye.
From all over the world.